Welcome to Chit Chat Stocks. This is another episode of our weekly Power Hours. I am joined, as always, by Brett Schaefer. My name is Ryan Henderson, and on these episodes, we talk all things financial markets. We do these shows live on YouTube on Wednesdays at 10:30 Pacific Time, 1:30 Eastern Time. So if you have any questions, feel free to get them into the chat. Just look up Chit Chat Stocks at that time on Wednesdays, and you will find us, or I'm sure you can hit subscribe or whatever, and it'll give you the notification as well. But uh, we are, I guess, not maybe the heart of earnings season, but the second week, kind of I'd say these are the two biggest weeks, and we've got a little bit of the smaller companies reporting. Although last week was Amazon, last week was Apple, and we weren't able to get to those on the Power Hour last week. So we'll be talking about those as well. Plus, a couple other intriguing stories for the week. Any headlines for you, Brett?
Yeah, I think I'm gonna do an hour on full election trades. No, we got lots of things to talk about this week. Nintendo update. They had earnings, which are boring, but they had some interesting updates along the lines of their new console. I have Coupang earnings, which is a company I follow very closely, as well as the Perplexity AI funding round at an interesting sales multiple. Let's just leave it at that. But yeah, we're recording this, let's say, on Wednesday midday. So I know maybe not that many people are going to join us live. There's some other stuff that you might be worried about, but we got important things to talk about, and they are small, mid cap, large cap earnings, and our thoughts on those.
Yeah, there actually are. There's one company I'm going to be talking about today that has been affected by the election results, at least as far as the stock price goes. We'll see if the business is affected. And that's a little tease for my small cap of the week. But before we get to that, I do want to talk about our friends at Public. Heads up, folks, interest rates are falling, but you can still lock in a 6% or higher yield with a bond account at public.com. That's a pretty big deal because when rates drop, so can the interest you earn on your investment. A bond account allows you to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds. So, while other people are watching their returns shrink, you can sit back with regular interest payments. But you might want to act fast because your yield is not locked in until you invest. The good news, it only takes a couple of minutes to sign up at public.com. Lock in a 6% or higher yield with a bond account only at public.com/chit chat stocks. All right, where do we want to kick things off, Brett? Amazon, obviously, headline. That's kind of one of the most known companies, probably the biggest one that reported. I guess Apple as well, which Apple, I'll say, boring report. So boring. Um,
Slightly better than expected, but still boring. Not really
always.
growing that much. When your expectations are that revenue is not going to grow and then it grows a little bit, hey, that's positive. I was pleasantly surprised, but yeah, nothing to talk about. Hey, we sold more iPhones. Okay, none of our new products are working. All right.
Yeah, I think I read headlines about them basically shutting down the what's it? AR glasses? The
Yeah, I think
VR
so.
goggles?
Yeah.
That's not surprising at all. And you know what? Kudos to us because we called that a flop when they announced it, and everyone's like, "This is game changing," and it was a flop. So I'm gonna give myself a little pat on the back there. You were right. I believe your words were, "If you wear this in public, you will look like a dunce." I think
I
that
don't know if I use that words. I think it was a an anti-chick magnet or something like that for guys. But I thought when those people were walking around with those, that was some funny stuff.
yeah, you look
Either
like a
way.
bug. Basically, anyways, needless to say, it doesn't seem to have caught on. Also, Reality Labs is still hemorrhaging money, so it doesn't seem like there's been a whole lot of success in that realm in general. But let's go. Maybe we kick things off with Amazon's earnings here. Pretty strong report across the board. I don't think anything surprised. I'd say like it was pretty much in line with what analysts were expecting. AWS was a little more profitable than it hit record profit margins and it continued to grow. It actually grew 19% on the top line and they crossed more than $100 billion in last 12-month AWS revenue. So kind of a massive milestone there. Retail's still growing, not quite as fast as the cloud business, given the size of that retail business for them overall. And then they talked a ton about AI, as you might expect. Code Whisperer, Bedrock, SageMaker. I'll be honest, a lot of the products, I'm not sure exactly what the fit is or who they're going after. It seems primarily to be developer first AI products as opposed to ChatGPT. You maybe think that's kind of more focused on the public. So that's kind of where Amazon's angle is. But it seems like the AI investments from Amazon side have been really geared towards helping developer productivity.
You don't like Rufus? Have
I'm
you seen
sorry,
that?
I have not seen Rufus.
Go, if you go on Amazon.com right now, they have their apparently helpful chatbot is called
Oh
like
boy.
Ask Rufus, which I think is a terrible name. It's kind of funny. Like I'm not asking my dog about questions.
Yeah, it's hilarious to see people come up with like all these different names for their
Yeah,
AI
tons of
when it's literally just
meetings, a
like
lot of consultants.
it's
That's
basically
right.
Clippy all over
Yeah.
again. But whatever. Um, Advertising was solid again. They continue to grow their advertising services business at double-digit percentage. I think it was around 20% this quarter. Don't actually have that number in front of me, but growing faster than the overall retail business, which means margins are growing. Operating margin for the business overall, last 12 months basically hit 10%, a record high, um, and a record high by a long shot. And it's my I think there's still tons of room to grow that operating margin, especially as AWS grows as an overall piece of the pie. It's naturally going to raise operating margins, but they have a lot of higher margin initiatives. They've basically been ironing out the logistics questions that were raised from 2 years ago, and part of that was there was just a bunch of temporary costs that had risen. I would not be too surprised to see AWS or sorry, Amazon overall with 15% operating margins in 3 to 5 years.
Yeah, I was actually going to ask you, we're on the same wavelength there. I was going to say in 3 years, do we hit 15% margins? Because that was kind of my target as well. I think there is a clear path to that. And when we had, oh, why am I forgetting his name? Well, I'm sorry. He's a great guest we've had that did a fantastic research report interview on Amazon, I think at the beginning of 2023 or late 2022.
Ed
Either way,
Ed Chang.
yeah, thank you. And he said there was a path to 15% operating margins. And at that time, you really had to squint if you look at the consolidated numbers because the consolidated numbers were 2.5%. And a lot of people are saying, well, they're never going to be profitable at retail. Now we're seeing a ton of progress there, and it's no surprise. The stock's up about 100% since then.
Yeah, it's been quite a good performer. I will say, and I kind of go through different periods, or I feel differently in different quarters, but sometimes I think, wow, these are the best businesses in the world. I should just own these. And then some other quarters, I think, man, these are the most boring stocks to own. Like, where they seem, everyone follows them. How could there be, like, I don't know. It's not as fun of a journey as I think investing in companies where the moat is not already super evident, where it isn't a 2 trillion, $3 trillion market cap, and you believe that there's, I don't know, there's at least the allure of potentially much larger upside.
I agree. Now, we don't have the numbers in front of us. And I know you, as well as me, haven't looked at the valuation work on a lot of these companies because I don't think we own all of them. But if we go for the Mag 7, excluding Tesla, because Tesla's the absolute wild card. So Nvidia, Meta, Alphabet, Microsoft, Apple, Amazon. I think that's all of them. Gut check. What one's the best to own over the next 5 years?
Ooh, next five. I'd say
I'll tell you
Google or
mine.
Amazon. Google or Amazon, most likely.
I got uh, Alphabet or Google. Yeah.
The, yeah, it's probably Google. The thing with Amazon is I I think there might be more margin inflection than people are expecting with some of the recent, I can't say layoffs, but layoffs. Like I'm sure a lot of engineers are going to be looking for other roles where they can work remote, and I think it might have a more like a larger impact on headcount than people expect. it sounds like, and I know it's always anecdotal and it's usually overblown, but people, at least locally in our area, a lot of people have been affected by it in one way or another and might be exploring alternatives in terms of work. So if that is the case, yeah, I think there's a good chance that operating margins inflect a little higher and maybe it beats out Google. But as far as just pure, yeah, if I had to pick one, I think I'd probably go Google as well.
All right. You want to talk Nintendo? Because this was a very one of the I don't know why I find these funny, but there was a absolutely hilarious announcement. Unless you have anything else on the big tech companies.
We can talk Nintendo in a second, but I want to show you this chart. Let me just make sure I've got the chart right here. Um, all right, sharing my screen. Here is AWS revenue, Microsoft Cloud revenue, which isn't really, I mean, it's not, the majority there is not infrastructure and services, like infrastructure
The
services, I don't
majority
think.
is
Could be wrong.
infrastructure services, but
Majority
they
is,
also
but
have
they have the
SaaS, right?
biggest, yeah, they have the biggest percentage of non-infrastructure services in their cloud revenue division relative to AWS and GCP.
Gotcha.
Um, so it's a little distorted, but all this is to say, basically all these businesses are growing at 20% or higher. They are. AWS was at 19% this quarter, but it's the highest or it's the largest cloud provider. Have you ever seen an industry, and I guess you could, I don't know if you can call these three specifically an industry in themselves, but I think you probably can. Uh, have you ever seen one at this scale growing this quickly?
Online advertising back
Yeah, that's a good
10
call.
years ago,
But you
which
know
is
what? I
really two
think they're
companies.
probably similar size if you add up the, well, no, maybe not. I was gonna say Meta's revenue plus Google search plus YouTube plus AWS revenue. It's probably they're almost probably nearly the same size.
And you said AWS, you mean Amazon advertising?
Sorry, Amazon ads, yeah.
Yeah. Yeah, it is an interesting chart. It's a great chart. It's for anyone that wants to check it out. Thank you for everyone that signs up with our link, finchat.io. Check it out. These are some of the custom charts you can make over there and help us out along the way by using our link in the show notes. But what I would be interested in seeing in relation to that chart is operating income and free cash flow. Because I'm always curious, given how much capital expenditures they're putting up, what the cash flow conversion looks like at various points in the investment cycle. Like, are they not going to generate that much free cash flow until revenue growth slows down a bit? And yeah, I'd just be really curious to see the full P&L for these divisions.
Yeah. I mean, Amazon talked about their CapEx being poured in here, and I think they're expecting $75 billion for this year, and potentially they said they expect more next year. If you're looking at, if we assume half of that is for cloud, which I believe was around the ballpark that they said. It was like, I think a couple quarters ago they said like 50% goes to like cloud services.
I think, are you saying Amazon? I think it's higher now, right? It's going to
Yeah,
be an
probably
increasingly
is.
percentage.
So maybe call it, if they do $80 billion next year in CapEx overall, let's say 40 to 50 billion of that goes to AWS. That is a huge sum of CapEx. Right now they're doing, over the last 12 months, they've done $100 billion in AWS revenue. So it, and the CapEx, from what I understand, is generally forward looking. It's like when they have the demand. I mean, they can forecast the demand with a lot of it. So
Hopefully. Well, they do have long-term deals.
yeah, it's got to be pretty profitable. And yeah, I mean, obviously, if they're growing quicker, they're going to put more money into the CapEx. But I suspect it's still quite profitable. And if it did ever slow down, you'd see inflated or inflected margins.
Yeah, I agree. All right. Nintendo, do you want to hit
Go
this?
for it.
So they had their earnings, kind of boring. They didn't have that many games. Profits were still strong, which is a good indicator that the cyclicality of the console is more muted given their Nintendo Switch Online stuff, software sales, and the continuous games they're pumping out because previously this would be close to the trough of the earnings cycle because they're about to release the next game, or excuse me, not the next game, the next console sometime in 2025. But the best part about the report was, and as I said before, I don't know why I find these so funny, but they take over the Nintendo corporate account on Twitter. And I just imagine it like one of those PSAs, emergency alerts where they have that blaring noise. You know, it's not someone's personal account, but they just take it over and this is the president. They go, "This is Furukawa. At today's corporate management policy briefing, we announced that Nintendo Switch software will also be playable on the successor to Nintendo Switch. Nintendo Switch Online will be available on the successor to Nintendo Switch as well. Further information about the successor to Nintendo Switch, including its compatibility with Nintendo Switch, will be announced at a later date." And then he just disappears. It's like he's a wizard and he just disappears into the night. But I just love how he goes, "This is Furukawa."
Well, they need to know that it's coming from the man himself.
Yeah.
Uh, this is actually what we talked about recently, I believe, and
Mhm.
not to victory lap you, but you did say that would make no sense for them to have backwards compatibility because it would hurt hardware sales. So,
Well, I'd say on the new games.
oh, you're saying, oh,
So
you were
this is
saying like,
on the games that are out right now.
so I guess forwards
It would
compatibility with
go
existing
against
software.
all Yeah, it would go against all of the other gaming companies if they said our new games could be played on the old console because then eventually you're like, well, it's way too technically difficult. It's like the newest Call of Duty getting played on a Game Boy.
Okay. So I don't know. What's my takeaway on this? They pretty much already kind of have it, right? I mean, they retrofitted old games for the new Switch.
Yeah, and I think well, so you're gonna be able to play once you buy your new hardware, you're gonna be able to play all your old games on that hardware. And I don't know how much is gonna mix and match because we've seen that with the say, for example, some of the sports games from Electronic Arts. Sometimes they're only available on the new console, sometimes they mix and match, but it depends how old it is. I think what's important here, though, is that they care about bringing over the Nintendo accounts, bringing over the existing player base, and saying that Nintendo Switch Online is gonna just be rolled through to the new system. So we're not starting at 0 again. It confirms a lot of the thesis, I think. Does it make you more bullish or bearish on Nintendo?
Mm, probably about the same. I do appreciate that there is this. They clearly are don't want to go through a deep cycle again like they have in the past, and they have taken steps to make that the case. But if the idea is that you basically get like new hardware announcement, revenue accelerates, like whatever, maybe it jumps 50%, and then it's flat for 5 to 6 years, and then you go through the same process again. That doesn't, I don't know, it isn't that enticing to me. I feel like it's Groundhog Day for us here because we've done this like for 4 or 5 years. No, I'd say 3 years now, where we've seen the earnings. It's been okay. Honestly, probably bad relative to what our expectations were when we underwrote the investment.
Well,
Because
not this quarter. I mean, there's no games that came out.
no, but if you
Last year was
if I
very
showed you the
strong.
revenue chart for 2024 in 2021, that would not there's no way that's what we were expecting. Flat revenue, flat to declining revenue for 3 years.
Yeah, but we also would have said, did the new console come out? Because again, since within the last year they haven't released anything new. Sorry,
Oh, but we've been
anything
saying that
big and
every
meaningful.
quarter. But it's like
Well,
it
last
feels
year
like it's
they
been
generated
around
a
like it's the end of this year, next year, like for the last 3 or 4 years, and it just hasn't really.
well, yeah, because now for this like the last few quarters, they haven't released anything. Last fiscal year, they released a huge blockbuster game, and I think 2, um, the Zelda teaser, the Kingdom one, and profits went up a lot. Now the yen is getting destroyed, so that doesn't help.
I
but
would love to be wrong here, but I just if you take this over 2 decades, what do I think grows earnings faster? Nintendo or, I don't know, Google? I'm probably gonna go Google.
on average, yeah, but who generates more cash flow versus their current enterprise value? Like, as
I
a
don't know,
percentage of the current enterprise value, I'd say Nintendo.
what are they at?
Ooh, well, it's kinda hard to calculate sometimes because of the
Well, once they monetize that Pokemon stick.
yeah,
Once they sell their
it's
ownership in the Mariners.
yeah, that doesn't matter. But it's hard because sometimes you gotta convert to yen. I don't know how well I can do this live. Uh, I think the enterprise value, let's try to get it on FinChat here, would be
Do you have a
something
rough
around 50
earnings
billion.
multiple?
Probably, yeah. I just gotta pull up that one table where you can convert it from yen to the dollar. And I think sometimes the enterprise value isn't necessarily correct just because the way that it's calculated might be different depending on different areas. So if we want to go to ratios on the chart, load that up. I'm guessing
Probably
it's going to
what,
be 40
15
billion EV.
in net cash? 10 in net cash?
I think they were probably close to 20 billion in net cash. Um, let's see, total enterprise value, and then let's do USD. All right, I think I got to load it up here.
And how much have they earned over this
44 billion would be the
44
number right
billion
now.
for the enterprise value? How much have they earned over the last 12 months?
Oh, the last 12 months, not very much. But over the next two
Okay,
decades,
average over the last 3 years, the annual average.
let's see. Operating income, is that fine with you?
Sure, I'll take it. Yeah,
Okay, we'll go. Let's see. We'll start with the say COVID year. Then it just goes down from there. 5.8 billion, 4.9 billion, 3.8 billion, 3.5 billion, 2.6 billion over the last 12 months.
I didn't realize
Um,
they had, I guess COVID was quite elevated, but
yeah, yeah, and the yen. And this is USD.
so call it 10 times earnings.
A trough earnings.
No, call it. It's
Oh,
probably,
normalized.
yeah, because
Yeah.
it's probably 15 times roughly, uh, last 12 month. But yeah, I don't know. Just,
I mean, is Alphabet
it's
gonna
harder.
generate 250% of its enterprise value in the next 2 decades? Maybe, but I think
I,
it's closer than you're thinking.
maybe I just don't have that much I would be more confident that in Google's earnings growth than Nintendo's. I don't know. We
Yeah,
go back and forth on this all the time. Are you a shareholder today?
I am. I'm currently a shareholder, thinking of adding, just because this election results, the foreign currency stuff is getting hit, and it was right when they just confirmed all this stuff that basically we're hoping with the company is correct. All right, we had a comment here that says thoughts on Uber, $2 billion in free cash flow last quarter. My thoughts are the same, I would say. Good business, and there's Waymo risk that people are underrating. And it's turning into a battleground stock around a Waymo and Uber, but I still would not underrate the Waymo risk over a decade time period because I want to hold something for 5 years or longer. And I don't know what Waymo is going to materialize to in 2030, 2035.
Yeah, I'd say developing moat for sure. That moat could be potentially challenged by Waymo, but I definitely prefer what they've done with Waymo so far in terms of the partnerships, as opposed to just no partnerships at all with them. It at least gives them potentially some synergies there. The other, not synergies, but some maybe integrations and some goodwill between the two companies. The other concern is that the valuation is just high. It really is quite a steep valuation today, if I remember
Well, one,
correctly.
I got the page loaded up. What do you want me to look at?
For them, definitely don't do adjusted EBITDA or segment level adjusted EBITDA. I would just take, I don't know, EBIT. It's probably fine. I don't think they have too much interest.
it, it says 59.
I
That
don't
might be
think that's
high.
wrong,
Really?
actually. Yeah.
I'm seeing 11 times gross profit. And if they aren't putting customer support in gross profit, that's their true gross profit's probably higher. Or sorry, gross profit multiple is probably higher. So 11 times gross profit is pretty expensive,
Yeah, and
I'd
they
say.
have like 30,000 engineers, right?
Yeah.
They have like as many engineers as some companies that are significantly larger than them. So the OpEx line is going to be pretty high. It's just there is still the from Silicon Valley kind of more willy-nilly about spending than maybe some other companies. It's just to me, yes, it was attractive 2 to 3 years ago. Didn't end up buying, which fault to us because we actually did look at them. But I just don't think cash flow is going to grow at the rate that everyone is hoping here. And especially if they decide to pursue that Expedia acquisition, I would be concerned.
Yeah, the Expedia one, let's not do that. So are you saying you're flipping on the direction of our perpetual Airbnb Uber bet? Short term, do you
That
think
was a
the
timely
gap's gonna
bet.
close?
That was a timely bet. Uh, and I'm closing that bet now. Yes.
Not re-upping it? No double down?
No. We'll see how Airbnb's numbers come out. I think they report tomorrow, actually.
Yeah, tomorrow or today. I heard, and well, I guess we try not to swear on the show, but I heard that Thursday's the shit code day.
I
It
saw some concerning names that were
Yeah.
reporting tomorrow.
We're all we're really worried about these results coming out this week. There are some
Yeah.
concerning numbers.
Yeah. I don't love Uber, just to be honest. I do think it's got a good advantage, especially
It's a good
relative to
business
Lyft.
now.
Yeah, it's good business, but it's just priced like it's going to grow, I think, quicker than it really can in terms of earnings. Um, yeah, I don't know. Not too much. I don't spend a lot of time on Uber or Lyft, actually. We visited them last week. I haven't spent a lot of time on them either. It just kind of is like a tough equation for Lyft if they are constantly price competing with Uber for me.
Are you saying in relation to Lyft being a bad investment or Uber being a bad investment?
Lyft.
Yeah.
If they're the price taker, and I mean, they have people that are still kind of loyal to the service, but just where's the differentiation? Like, what's going to, if everyone's going to price shop each time, are they going to be able to get to like sustainable double digit profit margins? No, that maybe they don't need to, but it seems
And
unlikely.
I'll sound like a broken record, but you should look at some of the stories coming out of San Francisco and how they've fallen in love with Waymo. Now that's a tech forward city, but don't discount that. People say there are plenty of advantages. For one, if you're a group in a car, you don't have a driver talking to you, which some people might say, well, why don't you want to talk to someone? Well, it's because sometimes they are maybe a little bit loco. Uh, and then two, the driving is always safe because there are those bad experiences people have where the driver goes crazy.
Trying to
Like,
complete the drive as quickly as they can. Yeah.
yeah, yeah, exactly, like a roller coaster. So
Okay.
just think about that risk in North America.
Yeah, I'd say there are some benefits to not having a driver. I do want to talk about the fast food fall off term I coined. Uh, patting myself on the back here a couple times throughout the show. No, I was trying to think of something that would be catchy for it, but basically, shout out to FinChat because they track comp sales for basically every quick service restaurant, every fast food brand, and every single one I've looked at has had sequential declines in their comp store sales growth. McDonald's, sequential declines are actually having negative comp sales. Burger King, KFC, Taco Bell, Pizza Hut, Tim Hortons, Popeyes, Starbucks, Chipotle, Wendy's, Domino's, every single one has had sequential declines in their comp store sales growth. That's just meaning the year over year comp sales growth was higher last quarter than it was this quarter. And here are some quotes that I found from the conference calls. So for McDonald's, Says the industry environment remains challenging. There's no doubt about that. I mean, I think consumers are under pressure. The industry is contracting in a number of our largest markets, and in fact, that contraction worsened in the third quarter. Domino's says we knew consumers, and they actually had positive comp sales. It was a decline from last quarter, but they had positive comps. He says we knew consumer spending would be pressured in 2024, and that the quick service restaurants that offered the strongest value would win. That proved to be right. Restaurant Brands International says and Popeyes in particular had just a huge drop in comp sales. Um, says in a more value sensitive environment this quarter, Popeyes calendar was missing some of the offers consumers were looking for, and this resulted in softer comps. So my question to you, first of all, does this make you feel maybe if you were a Starbucks shareholder, does this make you feel a little better that it's not Starbucks exclusively?
I think it does. I think it does. And Starbucks is not something I want to own. It's too big for me. But depending on the price, it could be something people are interested in. This new management team, especially with the record at Chipotle, seems to be doing the right things. Where we're
I
not
agree.
doing this weird consulting strategy mumbo jumbo. It's like we're gonna get back to just providing the best quality we can.
Yeah, I agree. I've kind of flipped a little bit on Starbucks with some of the changes they made. I saw those ads that you talked about where it just looks like really delicious coffee for
That's
like
gonna work. They're
20
gonna work.
seconds. Yeah, that's good. They got rid of the upcharge on non-dairy alternatives. That's definitely going to work with so many people that do that because I saw personally, anecdotally, tons of people like talking to each other about that. I've heard that in conversation quite a lot.
The forced tipping stuff. I believe they switched that or maybe not. I
I
don't
don't
know
know
if I
if
was
I've seen
reading.
that pulled
Maybe
back
that was
yet,
another company,
but
but
my other discussion question here is all the comp sales declines. Do you see this as kind of a healthy pullback? Because prices, a lot of companies push price following COVID, or an early indicator of a weakening consumer.
yeah, that's a great question because you might say, all right, we've normalized these things could be biased depending on what the price is. But you look at some of them like McDonald's and you go, well, why am I buying this at 25 times earnings? On the other hand, who knows where the bottom is on these comp sales because if the consumer wallets are tight, that can happen. And I think it leaned to it being just a period of normalization where they push price too much. Now they got to give a little bit back, and then we're going to get back onto the normal trajectory. I'm going to show you this chart though, Ryan. Company I follow and own, Portillo's, something that we've did a full research report episode on. If anyone wants to go check that out, here is the comp sales figures for them on
Another
FinChat.
decline.
The last 3 quarters, we've seen slight declines. Now, given the context with the entire industry, does this make you how would you feel as a Portillo's shareholder? Does this make you more comfortable seeing all that context or no?
Mm, I think for them it's a little messy because they aren't quite as mature and they're opening a lot of new stores relative to their existing size. So I'd probably be more focused on average unit volume or average unit values and store growth there because comp sales can be messy because you can do a lot of like discounting in the first year or the first year might be lighter than the second year. So or kind of vice versa. You might get sort of a honeymoon effect where a lot of people come in that first year. So I just want to be too, I guess, focused on the comp sales figure. AUVs, especially commentary around AUVs in their expansion markets, are probably the number one kind of KPI or value that I'm probably looking for.
Yeah, that does make sense. I agree. And AVs will come down a bit, most likely. If they don't, well, that's a tremendous result because the Chicago area ones have very high unit volumes, and the ones outside Chicago are going to have lower ones, but are still profitable. Okay, we want to do small cap of the week, Ryan.
Yeah, in a second, we do have a question too on coupon earnings. Before we hit that, I do want to mention our sponsor one more time, Public. Heads up, folks, interest rates are falling, but you can still lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds on public.com. You might want to act fast because your yield is not locked in until the time of purchase. Lock in a 6% or higher yield with a bond account only at public.com/chit chat stocks. What about coupon earnings? Do you want to touch on these or do you want to wrap with that?
Yeah, it seems like every company I I own reported in the last 2 days. Kind of a weird thing to happen, but yeah, I can talk coupon earnings pretty easy. I would say that the stock going down today is might be getting exacerbated by the foreign currencies devaluing versus the dollar. So I don't know if that's having a huge impact, but it might be. If we look at the numbers, and this is all in US dollar figures, 45% total gross profit growth, 33% if you exclude inorganic growth from the Farfetch acquisition, developing offerings, which is international, fintech, coupon play, and I believe the food delivery business grew revenue 146% year over year, excluding Farfetch. They had stated profits that came down, but I'd say as a reminder to anyone following this company, they are not playing the quarterly game. They're actually anti playing the quarterly game. They don't care if some stuff comes in lumpy. Analysts kept hounding them on this on the call, and it got quite annoying when they said, "Well, what's the Q4 margin coming in as?" And they said, "Literally, we don't care." And they kept asking it. So that can be frustrating, but just don't think like, oh, hey, profits are down a little bit. This whole business is destroyed. You have to look at what they say. They're pretty honest with the investing community on what's actually happening with the underlying business. And if you trust the unit economics, gross profit growth, and then eventually profitability over the long term is what you should be looking for. And if we look at all their cohorts, every cohort, which is just kind of the year cohorts for all their shoppers is growing versus the prior year. So even people that joined back in 2015, they're growing their spending in 2024 versus 2023. Total active customers keep growing. And just as a little figure here for you, Ryan, $8 billion in last 12-month gross profit. Market cap's $43 billion, which I believe that's about 5 times. Yeah, 5 times gross profit. What do you think?
I don't know if I'm necessarily adding here. The I thought the quarter looked good. It's kind of a little frustrating that Farfetch acquisition just muddles everything. It kind of makes it hard to interpret. They do give the excluding Farfetch numbers, which all look positive, but I have my doubts around how that business will turn out for them. It
What if I
seems
told you that Farfetch is already profitable?
I saw that. I'd like to see what definition they're using for profitable
That's fair. That's fair.
because it's last quarter they chose. I think it was like we're aiming for adjusted EBITDA profitability by for Farfetch by the end of the year. So if it's that, I don't really care too much. I mean, it's a good indication that it's earlier than they expected, but I guess I just don't know what the integration is going to look like there. They talked about this R Lux business. Curious how that works out. It seems like it if I'm not mistaken, Farfetch had a uh, big presence in China. Like there was a big Chinese customer base there for Farfetch. So
Yeah, perhaps.
I've got a feeling that business volume wise is not soaring at the moment. But
Yeah, but
the rest of the business,
if there's one market that likes fashion and luxury goods more than China, it's South Korea. So this is a perfect market for a luxury online platform.
yeah. I wonder if they already had some sort of uh, presence in South Korea. I didn't really follow Farfetch closely enough, but it. I thought the quarter was good. Maybe I'm anchoring to like old valuations, but I just don't feel that inclined to add here. It's already a pretty big position for me. So good results. Like you said, they don't really play the quarterly game, so I don't care too much. Really, the biggest thing I'm looking at over time is gross margins on the core business, and I guess overall over time, and then making sure that that flows through to free cash flow margin in the long run.
Yeah, seeing the operating leverage there, and it's nice that they are self-funding and they have a healthy balance sheet as well. That can help them if there's any sort of downturn. And I agree with you. I don't think I'm adding here, but there's no reason to sell. It's a buy and hold position. I plan on holding this for many years and gonna keep doing that.
Okay. Do you want to do small cap of the week?
Let's do it. Small cap of the week. And you always say presented by Yellow Brick Investing in the notes, but I would like I think it'd be fun if you kind of did it as like a separate segment, you know? I like on one of those traditional media or sports stuff.
Not
You
sure.
know,
Not sure
they
I
do like
entirely
the
follow, but
they always do like a big intro music and then it's blank presented by Coors Light.
okay.
Coors Light.
I'll
Drink
work on my
responsibly.
commentator voice.
Yeah,
Small cap of the week presented by Yellow Brick Investing,
exactly.
the number one destination for stock pitches on the internet. Maybe just give them the slogan. We'll see. But yeah, so I'm cheating this week. I'm changing the definition for small cap of the week. It used to be basically $2 billion market cap was the max. I'll be totally honest, my iPad broke last week, and I haven't been able to do as much reading as I like, so I wasn't able to find one below 2 billion because I just didn't dedicate as much time to it. But I saw someone reach out to us recently about Yeti. They said they listened to our episode, which was 2 years ago. They said the takes were actually okay, and they've aged all right. So that's nice to know because sometimes I kind of cringe when people say they listened to an episode from 2 years ago. But anyways, looked at the market cap, 2.9 billion. So changing the definition here to anything below $3 billion market cap, I'm going to call it a small cap. Um, so Yeti, it's kind of a business we already know. And I will say we looked at it 2 years ago, thought it was richly valued, thought it was a little bit of brand risk. The stock is down nearly 70% from its highs. So I'm glad we kind of passed that away, and it's down 8% today on the election results due to increased tariff risk. This has been talked about a lot by, I think, Trump leading up to the election, just about raising the tariffs, especially coming in from China. And Yeti imports or manufactures a lot of the products in China, brings them in. So, yeah, it could theoretically have a big impact on them. But as far as the business overall, two biggest revenue drivers are coolers and equipment and drinkware. Drinkware is the largest for them. That includes all the, what do they call them? Rumblers, tumblers, all that stuff. Basically, coffee mugs, um, and other water bottles of sorts. $1.7 billion in sales over the last 12 months. The business has shifted more, especially since last we spoke. The business has shifted towards direct to consumer more over the last few years. Now, a lot of that has come from them adding stores, which kind of, I don't know, it affects margins because you got to run the stores. So there's like gross margins will expand, but there can be more employees in your operating expense line there. Um, and coming into this year, there was a ton of concern that consumers were going to trade down and it was going to affect Yeti. I don't think that's really materialized too much. The
What about
big
the
risk,
Stanley risk? There was
yeah, the
did that affect
stand
them?
it seems
Maybe.
like it. So Stanley tumblers, which have been extremely popular, they lead in terms of market share with the Gen Z consumer, has jumped to 15% market share in the drinkware category, from like 2% in a matter of a few years. So that is kind of a risk, I'd say. Now Yeti's a little more diversified, which is nice. So it insulates them a little bit, but it also kind of points to the risk inherent in this category overall, which is their brand so good that no one can replicate them? Or is this a business where it's really kind of impossible slash just difficult to establish a moat? I think Yeti certainly has a lot of brand value, but I don't know if I'd say they have a massive moat. If we look at the numbers, they've generated $253 million in operating income over the last 12 months, $162 million in free cash flow. I told you earlier, $2.9 billion market cap, a little bit of net cash, not too much. Basically, I think it's like less than 100 million. So enterprise value is similar. EV to free cash flow is about 17 times. I will say it feels like they're kind of under earning. I guess I haven't gone through all the numbers, but they had significantly higher free cash flow last year, so there's the potential that they had just a big under earning this year. 17 times free cash flow. They started a bit of a buyback. Um, they do it in a weird way. They kind of do $100 million in buybacks all at once, and then they don't do anything for a few quarters, and then they do it all over
Weird.
again. But they do have $200 million remaining on the buyback program. I guess my question to you, any interest here? And then do you think this is a bigger business in 5 years, at least in terms of revenue?
I don't have any interest because I don't know if they're gonna be bigger in terms of revenue in 5 years. I think it is a good brand, but brand is tough, and there's nothing else here that attaches you besides the brand. I mean, hunters, fishermen, they love this brand. People like it. You have this stainless steel stuff. I think, yeah, you said the 17 times free cash flow, but on an earnings basis, they're about 10 times almost, or maybe like 12. That feels like fair value to me because I, earnings could go down. I have no clue. So when you don't have that confidence in the durability, yeah, I don't think 10 times earnings is that cheap for them.
What do you think about cookware as a potential growth vector? They
Yeah, they
talked
did
about this in the
start that,
last
right?
conference call. Yeah.
Yeah.
They're really touting their new skillet.
Yeah, isn't it like a $400 skillet? The what are those? The cast iron skillet. Let's look up how much it is. I'm gonna hit the
You
old
buying
Google
that?
machine right now. $250. Cast iron skillet, 12 inches. You gonna get that?
I can't say that that is really the kind of thing I like to spend up on.
Yeah, me neither.
Yeah. So probably not. But you know what? Look, people, hunters, fishermen, they
And
might
even
need
yeah,
some
just
certain cookware. I it makes sense as like an ancillary category to go into.
yeah, I agree. It does make sense. I think Yeti's brand makes sense under a parent company, but betting on this brand as itself, I don't know, doesn't doesn't really appeal to me. Like, what sort of bet am I making? Like, I have any foresight on how strong Yeti's brand is going to be in 10 years? I don't know. Stanley came out of nowhere.
Yeah. Yeah, I mean, exactly. There are so many brands that could pop up. Yeti popped up and has succeeded
Yeah,
and probably
yeah,
replaced someone before them. So it's yeah, I just worry that about the moat here. Celsius, on the other hand, talk about brands.
yeah.
Uh,
Wait, do you want to do our ad read for Yellow Brick? Tell people where they can find them before we
oh
move
yeah,
on.
join yellowbrick.com/chitchat. For anyone that doesn't know, a lot of that research I just found on Yeti, aside from having researched the business before, found high quality write ups on Yellow Brick investing. Literally, I highly, highly recommend just typing in joinyellowbrick.com. If it's a company you've never researched before, type in the ticker. You are bound to find a high quality write up from somewhere across the internet. They compile thousands of blogs, newsletters, fund letters, podcasts, ours included, uh, all into one place. So they make it really, really easy. And it is free, but if you want to upgrade, you can use our code joinyellowbrick.com/chitchat for a discount. Not blanking on the discount right now. But the other thing I'll say, he started another web page called uh I think it's like my application to VIC got rejected.com.
Oh,
So
nice.
it's like if you are an investor, you like trying to publish your research and you applied to Value Investors Club and you didn't get in, highly recommend at least just posting it there. I guarantee you'll find a little bit of an audience that likes it, gives you some feedback, kind of a sounding board. So, um, or maybe you can do it on both. But yeah, with that said, you want to talk Celsius earnings?
Let's do it. Yeah, and then after to close out, I want to talk Perplexity and their funding round.
Okay. As far as Celsius headline numbers go, revenue in North America declined by more than 30%. That is the biggest revenue decline in more than 10 years. However, this was kind of forecasted because last quarter they announced they had inventory issues with Pepsi. It was kind of a he said, she said here with Pepsi saying Celsius was saying Pepsi overordered. Pepsi said they had too much inventory. Maybe it was a Celsius problem. I don't know. Ultimately, it does end up being a Celsius problem because they sit there with a lot of uh, they Pepsi doesn't need to order as much. So because they have all the inventory. On one hand, I say I don't think those drinks are going bad, so probably sort of a temporary problem, but it ended up being quite like I said, quite the significant revenue drop, and analysts I remember reading that, what analysts were expecting in terms of revenue, and I thought that, like, no way it's gonna be that big of a drop. I think we talked about this on our Celsius episode, but
It
ended
was
up being
widespread.
yeah, fairly accurate. They are now basically in a 70% drawdown again, largest drawdown, kind of reaching the lows from 2 weeks ago. It I don't know. Thoughts here? It seemed like they're still gaining share in the category, but the category overall is slowing down.
Yeah, but they're also their market share gain growth rate is slowing down, which should be, I think, a little bit of concern. There's also C4 and Alani Nu that are growing. Market cap today is $6.8 billion. I think I get to the same conclusion I did on the episode. I think the brand's pretty durable. Like, I would much rather bet on this than Yeti, just because of the nature of the industry. But it's not as cheap as people were thinking then. And yeah, I have the same thoughts today. It's pretty close to being where I'd say it's a buy, but we're not there yet.
All right. Yeah, it's kind of stock was down like 6 or 7%, but I don't I didn't think there was too much in this earnings report that surprised. They seem to be
No.
getting hit from the sides with competition, uh, especially from brands that are not the one it's not like it's this major comeback from Monster and Red Bull, it's a push from upstarts, which
Hmm.
has hurt them for sure. No, I think there's easier investments to make out there.
Yeah.
Uh,
Like, my thought is it probably works, but
yeah.
I think my risk reward meter is not exactly in the buy zone yet, if that makes if that's understandable.
I say the same thing about LVMH. Like,
Yeah. That's it's just a big company.
yeah, probably works, but I probably won't participate.
Wow. It keeps going down. LVMH.
How much did Perplexity raise?
Oh, um, $500 million. But you know what? I'm gonna tell you before we finish the episode about our friends at FinChat that we've used throughout the episode, finchat.io/chitchat. Get 15% off any paid plan. All those KPIs, all those charts, use them yourself and help us out by using that link. All right, Perplexity, $500 million, Ryan, in funding. It is their fourth funding round this year.
Wow.
Valuation $9 billion. Now, I'll get to what revenue they are, but I thought in the Wall Street Journal they had quite the funny photo of the CEO, which it might be hard for you to see, but they just had him definitely not staged, him working at his laptop. Yeah, just get me kind of in the zone. All right, just give me while I'm clicking away here. Like, they're clearly coming in talking to you, and then he's going, "Oh, yeah, no, just get me typing away. We're working hard here. We got a lot of work to do." Um,
Yeah.
my Erlich Bachman rating on this guy is quite high.
Yeah. It's here's the thing for me is growing that fast, um, raising that much money in 4 times in a year, it's really hard to manage an organization with that much growth that quickly. Like,
Oh, I bet, yeah.
hard to have
Peter
a
Lynch
good
talked about it.
sense of costs. It's just easy to get excessive. It's easy to hire too many people, and all of a sudden you become bigger than you want to be. You're hiring people to manage more people. Like, you end up creating a lot of problems. Now, it might supercharge growth or whatever, but I think it complicates running an organization to raise it that much money.
Yeah, Peter Lynch. What did Peter Lynch say in the episode we discussed his investing philosophy? I'd rather have something grow at 10% for a long time than 50% and then drop a lot because it just ruins the consistency of the business and it can screw up management teams and it's much harder to deal with. Now, I said their revenue, Ryan. And here's the quote from the journal. Last month, Perplexity was on pace to generate, drumroll, $50 million in annual revenue,
In
$9 billion
annual or
valuation.
revenue?
Revenue,
Or sorry, annual and monthly. Okay.
annual.
Um, that's mm, definitely smaller than I was expecting. Way smaller. But people just it doesn't surprise me though. Like VCs invest in the tech before the revenue, they just do.
Yeah.
So it doesn't necessarily surprise me.
But how do you even come up with a valuation then? 7, 8, 9, 10? Why don't we just make it $1 trillion?
Yeah. And then it becomes the Ackman thing where you're like, oh, we'll be the catalyst. Like, we'll introduce them to all the corporations. We'll introduce them to the rest of our portfolio. Our portfolio will have to start using Perplexity. It's like, it's usually kind of not the cycle you like.
Yeah, I got a little tease for you, or not tease, an anecdote for you. I have access to Perplexity for free. I never use it.
Have you
I
have
it,
you have you ever used it at all?
no, I try to use it and then it works. Like I can figure it out. You just search, but it doesn't give me anything that Google doesn't now. So
Interesting.
I I haven't felt like, oh, I need to go back here because I can't figure out the answer to something.
Yeah. I think the LLMs for like just basic search is so overblown. I think that's probably where the biggest bubble is.
Well,
Is
there's one Google.
yeah. Yeah, and it's been 2 years now since the surge in ChatGPT users, and suffice to say, people still use Google search. So,
Mm-hmm.
uh, I did wanna do you wanna talk about Supermicro at all? I know we have, like, 2 minutes left, but I built a
Oh yeah,
timeline
yeah, oh
here
yeah. Let's
of
victory lap
just
this.
yeah. I just went through and just kind of went tried to find a timeline of what else happened to SMCI Supermicro Computer because it's fascinating, and it might be, like there's a chance it's a good investment from here. It seems unlikely, but
Oh,
there's a chance.
Ryan, yeah, no, 100% no. It's a
I
fraud.
know, I know, but it's all apparently the product is good. Apparently the product is best in class. If they fix, like, if they replace management, if there's somehow, I know that I think there's like a ton of internal control, but um, if they some sort of an activist and they changed all the reporting, apparently I read a thread that it's really sort of a Chinese company doing business in the US. A lot of the employees, most of the employees at the company speak Chinese. It's very much a Chinese culture. And someone was like, basically, there's just cultural differences and
Like committing
there's
fraud, not caring.
a, a lower regard for the law. Yes. Or
The
some of
accounting
the
law, yeah.
accounting law, especially in America. So I went through, and I'll just try to go through this quickly. But basically, Supermicro Computer founded in 1993 by a Taiwanese American named Charles Liang. He sorry, I've got my, dog making noise in the background here.
Oh, it's
So I
alright.
apologize if you
Just a
can hear
little just a little here, yeah, not too much.
it. So he left a job where he was working at, I think it's called Micro Center Computer. He was an electrical engineer, had a couple patents to his name. He from the jump, there was some red flags here. Of like the founders, it was him, his wife, and someone else. He basically 2 years later outsourced some of the manufacturing to Taiwan, where his brothers were running the manufacturer. So it's just kind of like very much using family relationships early on. but apparently they had a leading product and some of the most energy efficient and high performing servers, which it's been that way for a while. So they had success there. And come 2021, 2022, when all the tech companies started rapidly expanding their high performance computing infrastructure, Supermicro was there to benefit. And they're a big supplier to Tesla and Meta, I believe, as well. Um, however, you go through some of the company's history and there are some ugly truths. So uh, there was let's just go through all of it here. First of all,
Well, I mean, this
2004,
was all in the Hindenburg report.
yeah,
Like, people should have known this.
2004, I believe there was a some sort of a fraud charge. But then it started to get really ugly kind of over the last 6 years. I'm sure it's been a lot of this has gone on for a while, but in 2018, I did not realize this. Supermicro was delisted from the Nasdaq for failing to file financial statements on time. In 2020, they were relisted, but then the SEC charged them for widespread accounting violations. Well, they weren't guilty, but they settled, and it was a huge multi-million dollar fine. Months later, they rehired pretty much all the executives they let go due to their involvement in the accounting scandal. A whole bunch of disclosed and undisclosed related party transactions are going on in the business, most of which are basically around Charles Liang's brother, who's still the CEO. And the relationship we talked about with him having the manufacturing in Taiwan, which Liang like also owns that company. So he's kind of like just giving deals to himself in a way. Um, and then last week, Ernst& Young announced that they are resigning. I went and checked. They're getting paid $4.5 million in audit fees every year. So they are foregoing those $4.5 million in audit fees to because they don't want to be involved with the financial statements. It says, and I think you said this last week, but I'll go ahead and say it again. We are resigning due to information that has recently come to our attention, which has led us to no longer be able to rely on management's and the audit committee's representations and to be unwilling to be associated with the financial statements prepared by management.
Yeah,
There's
there's an
maybe,
obvious fraud.
yeah,
Obvious. There was why are don't own this. It was the Buffett is so right when he said, we don't short because we can't time it correctly, but the ability to identify scammy companies, scammy CEOs, and charlatans is pretty easy. And this one was clear.
yeah.
If you could
Now,
turn it
on the
into
flip
a
side, something we
okay,
thought
how
was
about
scammy, something we did think was scammy that has turned out great. And this is what kind of gave me the impetus for this, which is say you've got a good product, there's the chance that Carvana, okay, Carvana,
mm.
we thought they were screwed. Everyone did.
Well, that was more of just the business health as less of potential fraud.
Yeah, that's true. But if you can get someone else in there, if you can redo, like, you can keep the product, change the company, there's a lot of revenue. Fake revenue, maybe.
Yeah. Hey, Oracle did this, but that's a better business model. It's software, not reselling servers. Uh, I don't see a moat here.
Probably
Why
right.
wouldn't you? I would much rather own Nvidia or Amazon,
You
not
would rather,
not the middleman. That's a much smaller company.
yeah, I don't know if I'd rather own Nvidia here, but I mean, I
Well, if
guess
Nvidia if Nvidia goes down, Supermicro, their business goes down. So it's all connected.
true. All right. Well, yeah, there's just a little part of me that's like, what if? But yeah, chances are
It's
this
the
is,
next. It's gonna be like Luck and Coffee.
yeah. Hey, Luck and Coffee.
Yeah, I know. I know. I
It's
know.
working. The
Yeah,
model.
yeah. Uh, I just say listen to Buffett. That quote is very important, where he said, one, you can't just short these because look, super microcomputer went up 1,000%, but identifying them is not as hard as you think.
Yeah. No, I mean, there's red flags galore.
Hmm. All right, we're going a little long. Thank you for everyone for listening. Hopefully, we gave you some other things to listen to or watch or think about during the election week. Let's hit the disclosure. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan and I or any podcast guests may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. If you listen to this full episode, if you enjoy our episodes, consider giving us a quick review on Spotify or Apple Podcasts. I've seen people do that. It really helps the show. And guess what? We just entered the Spotify charts in Sweden, in the business charts. So thank you to the Swedish listeners. That's actually probably on a per person per capita basis, probably our best country. So really appreciate that, everyone. And we'll see everyone next time. All right. How was the